Hello and welcome. Today, we're going to dive into a story from deep within financial history, a story about a forgotten genius, a man who had it all and then lost everything in the blink of an eye. This is the incredible cautionary tale of Warren Buffett's forgotten partner. You know, when you think about the masterminds behind Berkshire Hathaway, two names always come to mind, right? Warren Buffett and Charlie Munger. But what if I told you there was a third partner, another brilliant mind who was right there with them, side by side? Well, that's where our story begins today. His name was Rick Guerin, and while that name might not ring a bell for most people today, he was absolutely a key player in the early days of Berkshire. So, why has he been all but erased from history? The answer to that question reveals one of the most crucial rules in all of investing. Just to give you an idea of how brilliant Rick Guerin was, you only need to see one number: 22,200%. That was the cumulative return of his investment fund, Pacific Partners, between 1965 and 1983. I mean, just let that sink in for a second. That's not just good, that's legendary. And his background was just as impressive. He was a math major from USC, a former IBM salesman who got into the investing world through his friendship with Charlie Munger. In fact, Warren Buffett himself said Guerin just got value investing almost instantly. This guy wasn't just some acquaintance. He was a true partner, investing alongside them in those historic deals for See's Candies and even Berkshire Hathaway itself. So, you've got this trio of geniuses working together. What could possibly go wrong? Well, as it turns out, history had a brutal plot twist in store. The market crash of 1973 to 74 was an absolute meat grinder that tested the resolve of every single investor out there.
And you can see just how brutal that test was right here. The S&P 500 dropped a painful 37% during that time. But Rick Guerin's fund, it cratered by 62%. So how on earth does a brilliant investor lose so much more than the overall market? It all came down to one very powerful and very dangerous financial tool. That tool was leverage, basically investing with borrowed money. It's fantastic when the market's going up because it supercharges your returns. But when the market turns against you, like it did back then, your losses get magnified dramatically. Leverage is a classic double-edged sword, and Guerin was about to find out just how sharp that other edge really was.
Those massive, amplified losses led directly to an investor's worst nightmare, the margin call. The brokerage basically calls you up and says, hey, you need to deposit more money to cover your losses right now, or they're going to start selling your assets for you. Guerin was trapped.
And here's the absolute heart of the tragedy. To meet that margin call, Guerin was forced to sell his shares of Berkshire Hathaway. And who do you think he sold them to? His friend, Warren Buffett, for about $40 a share. Today, a single one of those shares is worth over $350,000. A truly catastrophic mistake.
Buffett really hit the nail on the head when he explained what happened. He said this wasn't about intelligence. Guerin was just as smart as they were. The difference was psychological. Buffett and Munger knew they were going to get rich, so they weren't in a hurry. But Rick was in a hurry.
So Guerin's story isn't just about one person's bad luck. It perfectly illustrates a fundamental rule about risk that Buffett has been talking about his entire life.
Buffett has this powerful analogy for it. He says you can multiply a bunch of huge numbers together, but if just one of those numbers is a zero, the final result is zero. All your hard work, all your gains, gone. And throughout history, leverage has been the thing that introduces that zero into the equation, even for incredibly smart people.
And this experience really forged an ironclad rule for Buffett, both in his personal investing and how he runs his company: avoid debt. For him, it's not just a guideline, it's a non-negotiable rule for survival.
Now you might think, well, if I'm invested in a fantastic company, I'll be fine. But take a look at this. This is Berkshire Hathaway, arguably the greatest wealth compounding machine in history, and even its stock has gotten cut in half multiple times. If you are using borrowed money during any of these periods, it wouldn't matter how right you were about the company long term. You would have been wiped out. Game over. Here's another great analogy from Buffett. He says credit is like oxygen. When there's plenty of it, nobody even thinks about it. But the moment it's gone, it's the only thing anyone can think about. And in a crisis, credit can vanish overnight. And that's why, for Berkshire Hathaway, avoiding debt isn't just some financial strategy, it's practically a moral obligation. They do it to protect the life savings of their shareholders, to make sure they can always pay their insurance claims, and to guarantee that they can survive any crisis. And just as importantly, it allows them to go on the offensive and buy great assets when everyone else is panicking and selling. So all of this brings the lesson right back home to us, doesn't it? Rick Gurin's story really forces us to ask a fundamental question about our own approach to investing. What this whole story really boils down to is that successful investing is a game of patience. It's about having the conviction that if you just stick to a sound process, wealth will come. It's about resisting that powerful temptation to take a risky shortcut. So I'll leave you with this question. Rick Guerin was every bit as smart as Buffett and Munger. His only fatal flaw was that he was in a hurry. So you have to ask yourself, are you willing to be patient, trusting that you'll get rich over time, or are you in such a rush that you're risking it all? Thanks for listening.